Okay, so it's 6 o'clock, and I'd like to go ahead and get us started on time. Tonight, as normal, we'll go ahead and take some questions with respect to the problem sets that you're working on, and the Excel assignment perhaps, and see if there's any additional help you might need to get things finished up, so you can get them submitted by late tonight. And then we've got rather a lot to go through with respect to time value of money metrics, and mostly I'd like to really dwell on decision criteria using time value of money metrics. But my guess is we'll have to spend some goodly amount of time in a review of some TVM. And then I also indicated that a couple of you have asked if we could possibly talk about the stimulus package that was passed this last week and some of the possible effects of that. What I'd like to do, if you don't mind, is hold that part of the discussion to the end, so that only those people that want to participate in that discussion need to do so. And those that are not interested can then drop off, as those that are interested can stick around for a couple of minutes. Fair enough? Okay. So with that, what kind of questions might you have with respect to the material that you're working on? Solomon? Yes, I see your hand there, Solomon. I can't hear you. You need to unmute yourself.
Sorry, yeah, now I
There you go, buddy. Now we got you.
Yeah, so I have questions with KLM. So when I was solving this, I got different number for example, I mentioned about the K, the WAC. My WAC I'm getting, so the question K, like from the solving part, not the Excel sheet, I got the number of 1257656, whereas I was supposed to get something else. I was supposed to get what is that? Just give me a second, sorry.
Sure, and I'm bringing up that problem set, and I'm also bringing up the spreadsheet that I'm using in support of it.
Sure, yeah. I'm bringing your solution. Your solution says.
So I'm going to share my screen.
So yeah, I am ready now.
Okay, so WAC is item I.
No, no, not I. K. I'm saying K.
K.
This one, the value one. Sorry.
Okay. All right.
Because I'm getting a number different in this, that's why my L and M is also going to be different, because I'm getting different number here. So as you see, the final number you're getting 1257786, whereas what I'm getting is different. I'm getting.
Okay. What are you using for FCF1?
Which is 126024.
Got it. That's why. So I've given you 126,024 for free cash flow at time 0. So the base year, or the last year for which we have accounting information, we consider the base year, and that's year 0. And time 0 is now, or it's our most recent, okay? So in order to get free cash flow for time 1, which would be the next period of time, you need to take the cash flow for the base year and expand it at whatever the growth rate is that's been assigned. And in this case, we assigned 2.5%. So you're going to take that 126.
I use that. I use that. I multiply by 1 plus the growth rate.
Okay.
And that's why I'm getting this number. I'm getting a little bit different than what it's here.
Okay, so when you say a little bit different, read me your number exactly.
Sure, it's 1257656.
Got it. And are you getting that number because you calculated it using Excel or calculated it using the memory functions in your calculator, or did you just do the kind of math that you see here on this solution set?
No, I use Excel.
Okay, so this is I think going to be the difference. When I did this, I went ahead, I believe, and simply used the math as you see it on the solution set. And so that means that I truncated the cost of capital value. And so I put it as 0.1277 when we know in reality that number extends on for some decimals, right? So you're going to have a slightly different outcome because of the rounding differences. So, so let's talk about that for a minute, because this is not the only time you're going to see this. If you just run the math, grabbing your calculator and throwing some numbers in, and if you're not storing the responses and using the stored values out of memory, or if you're not using Excel, then you're going to lose a little bit of quantitative fidelity. And that's going to result in some slightly different outcomes. And slight, in the case of something that's valued at $1.25 million, slight could be $10,000. If it's something valued in the many billions, slight could be $10 million, okay? And you're going to say, well, Rick, $10 million isn't slight, but I'm here to tell you when we're talking about 200 billion, 10 million is a rounding error, okay? And in fact, if Jason and I were negotiating on a transaction and we got on a $200 billion or so transaction and we got to within $10 million of each other, I quit arguing and I just say thank you, because it's not worth continuing. And that sounds silly, but it's a big numbers issue. So you guys this coming week are going to go into a series of practice homework and homework problems where you're going to be using the quiz function within Canvas, and you'll be putting in specific values. I have tried as much as possible to put a rule around any of the outcomes so that if you have a slight rounding difference or rounding methodology from what I've used, but clearly have used the right equational structure, then you should end up getting the points for the answers. If you end up having an answer marked wrong, but it was just slightly wrong and you're confident that it's an issue of rounding, I simply want you to shoot me an email or a WhatsApp and tell me so I can take a look at it. Because it's not my intention to disadvantage you guys any earned points because you've used a slightly different rounding structure or convention that I have. So does that help?
Yeah, so in this case, should I leave it this way?
Yeah.
And so it goes for the L as well. So for the L, so all the numbers you have, I exactly have the same number, and I cross-check multiple times. L.
So yeah, it's going to go for any of these, Salman. If you are that close, you are either A, extraordinarily lucky, or B, you did it right, but just used a slightly different rounding methodology than I did. Okay. Cool. And when you're submitting the problem sets, remember, I do pay attention to them, but I don't pay attention to them with as much rigor as I do something where you don't already have the solutions. Okay.
Yeah. And my last question is kind of, if you go to the last one, N. Yeah. So I got my both, like when I plug in 11.56, which I found, I get 11,635, 305 for both.
Yeah, it's because you've got a fidelity issue both in the growth rate as well as in the discount rate. And so it's going to exaggerate the rounding difference a little bit. But even that, were this found within the construct of one of the Canvas quizzes, even that answer would be marked as accurate because it is so close. You can't get that close and be wrong in terms of your method unless you're just terribly lucky. But if you're that lucky, more power to you, honestly.
So having both values, like value 1 and 2 same, is that okay? Because that's what I'm getting.
So you're getting value 1 and value 2 as the same. Hang on just one second. Let me look at this.
If you want, I can quickly email you my spreadsheet. And
yeah, we you should be getting a number that's very close. In fact, you look at my number, I'm less than $6,000 different in an $11,600,000 value. And that's just a rounding difference. So yeah, they should be extraordinarily close. And the less fidelity that you've lost because of rounding mechanisms, the closer they're going to be.
Okay. Okay.
Very good.
Rick, can I ask a question on that too? So with that thinking, I'm fairly certain I know what I did as I move forward, but if I'm off from you, but my numbers are close to themselves, that's a pretty good indication that mathematically that I'm correct.
Yes.
Does that make sense? Okay.
Yes.
So my errors are the same in my, okay.
Yeah, and I tried, Jason, to even avoid using the term error here.
Okay.
Because it's a different rounding methodology, and more so than it's a rounding error.
Okay.
What other questions with respect to this problem set?
Maybe from you, Rick, just the explanations that you give for that, because the last two are essay in a sense, just so I understand it, because I'm not solid on it, to be quite honest.
So in this case, this comes back to that issue of free cash flow versus some kind of using the no-plat version and the KVD construction versus free cash flow using the extended equation. And we come up with the difference in possible G's that we've utilized here. Now, in this case, we've got a calculated G. So this isn't a long-run G that we've normalized at 2 or 3%. It's not a growth rate that we have observed from periods of time in the past. It may not even be a growth rate that we're thinking we're going to see in the future because of a forecast. This is a calculation of investment rate times return on invested capital. So I don't want to go too deeply into this. I just want to point out the singular issue that I was trying to make obvious in my answer, and I may not have done a great job of it. So when we use investment rate and we use return on invested capital, those are calculated values from specific years of information from the income statement and balance sheet. So when we get a growth rate using this calculation, that growth rate is going to be related to the growth rate of the firm in that particular period. So if we calculated these values as of 2019, I think it was, and that was year 0 in our example, these will be a growth rate for 2019. Well, okay, I mean, that's fine. It's interesting to know what happened in 2019, and maybe that helps inform what will happen in the future, but we're not constrained to that. And maybe we won't even see it. Maybe 2019 was a much better year. In fact, at the moment, it looks like 2019 was a much better year than 2020. It's the way this is shaping up to be, right? So we can't just say, well, here we've got this growth factor because of 2019, and that's the number we're going to live with. It doesn't work that way. It's just one of the many numbers that we might look at that helps inform us of what possible growth rates or what the inputs to kind of forecasting growth is going to be. Next week, we're going to spend some meaningful time talking about forecasting growth of revenues and forecasting growth of expenses. And I think this will come into a little bit sharper focus then even. Does that help at all, or does this muddy the water?
Yes. No, that helps.
Okay.
Yep.
The IGR, by the way, that you calculated, I think, last week, and the SGR, or internal growth rate, sustainable growth rate, same thing. They're two different growth rates that we might be able to calculate, and they don't mean that that's the growth we are consigned to, but they also don't mean nothing. We think about forecasting growth in part because of what we've been able to have in the past. A company that's never seen 20% growth in its life shouldn't credibly be expected to see a 20% growth rate next year, right? So these are just informing us of this, and this is where interpretation starts to kick in pretty heavily. Take a breath. And if you would like, I'm again happy to spend a little bit of time talking about the potential effects or impacts of the cash flows coming out of the Stimulus Act. So let me bring that up. And we'll only
All
take
right,
as much.
guys. Y'all have a good night. I'm going to head out.
Sure. Whoever wants to sign off, more power to you. And if y'all go away, that's not going to break my heart, but I'm happy to stay for whoever would like to have this conversation. So I was asked a question not too terribly long ago when I was
Is
interviewed.
it not necessary to be at this moment, or what is this exactly?
I'm sorry, say again, please.
I'm sorry, I might have missed because I kind of joined a few minutes late. So is this necessary to be part of this?
It is not. So a few of you asked if I would talk a little bit tonight about the potential effects of the $2 trillion stimulus package, and I've agreed to do so. This is not something that's specific to the class. You're not going to use it for our problem sets, assignments, anything. It's just if you are curious about a $2 trillion bill that you as taxpayers have now been committed to, I'm happy to talk about it for a few minutes.
Okay.
So with that, does $2 trillion stimulus package make any of you nervous?
A little bit.
A little bit. How come?
It's a big number.
It's a big number.
Big number.
I'm a pretty creative guy, and I can spend a lot of money. I can't even conceive of spending that kind of money. My sweet wife can't conceive of spending that kind of money, and she's world class. Okay, so that's a boatload of money, and I think it should give at least pause for concern. However, I will tell you from an economist standpoint, big spending measures and sometimes the big deficits that accompany them, because you have to know this is going to be accompanied by a gargantuan deficit for this year. I will suppose our deficit for this year will be, well, it will be in excess of $2 trillion because it would have already been some hundreds of billions. So it'll be in excess of $2 trillion this year. And we've never seen anything like that. That is only a problem when the monies are put to non-productive purposes. So if this $2 trillion or whatever part of it that is spent without being productive, then it's a problem. Because if it's productive, it'll increase GDP enough such that our GDP and our debt levels will still have at least a modestly healthy relationship. Some people talk about the fact that our GDP and our deficit levels are reasonably close in some years to each other as being problematic. And yes, that's not as comfortable as we might like. There are some economies that will have 200% a debt level to their GDP, and they do just fine. But it's about how they use the money. So if it's being put to productive uses that motivate GDP or increases or changes in GDP, then it may not be a problem. If it's going to line the coffers of some billionaire or foreign investors and we never see the money recirculating here in the US, then maybe that's a problem. So it's all about how it's used. So let's talk about then how some of this money is intended to be used. Some of you realize that as of the passage of this, that each domestic taxpayer is expected to receive a check in the mail or direct deposited sometime in the next several weeks. And for a single individual, that's $1,200 if they earn less than $75,000 in adjusted gross income in a year. And that over $75,000, it starts to pare down such that once you reach the $99,000 adjusted gross income amount, then the $1,200 is completely gone. You won't get that benefit. If it's two income earners in a household, then it's twice that for the household. Or if it's a married couple, it's twice that for a household. So not 75, but 150, not 99, but 198. So I think that most of the households that you and I would know, most of the taxpayers that you and I would know, have adjusted gross incomes of probably less than $100,000. Now this isn't their gross income, it's adjusted gross. So there's many deductions that have already come away from it. And if it's a married household, then it's going to be double that 99. It's 198,000. And my guess is in the Salt Lake Valley, let's say Utah, my guess is probably 97% of the households in the state have adjusted gross incomes that are below those levels, so they will receive this benefit. What good does the benefit do? Why would we step out something like $500 million, $500 billion to send this kind of money to households today?
Encourage your spending.
Yeah, to encourage spending. Or in some cases, not necessarily just encourage it, but because potentially the unemployment or underemployment or other fiscal effects of the coronavirus will have decreased cash flows to households, so decrease expenditures, which decreases GDP. And if GDP goes down far enough, we have a problem the likes of which we do not want to grapple with. So this is a stop measure. So think about this for a moment. Do we know what the effect of this crisis will be without this kind of spending bill? I don't think we know, do we? If we knew, we would call that the counterfactual. It's what would happen if we knew what was going to happen without something. So I think we realistically can expect that we'll have at least 2 calendar quarters of GDP contraction, so reduction of GDP. And 2 calendar quarters of that may put us into a recession. Maybe we're in one right now. If this goes on for a year or so, we'll call that a depression. That is a terrible economic scenario to be in. Hopefully we will not be there, but nonetheless, it's possible. So if that's our case, we know that we're going to have some major contraction, but we don't know what we don't know. So we put stimulus bills like this into effect to minimize the damage that we're only guessing is going to be there. So let's assume we wake up in a year and a half and realize that the last 6 months from that point, not today, but the last 6 months from a point a year and a half from now, we actually look back and saw the prior year, we had a negative GDP of 1%. So 1% contraction in GDP, which I would tell you, given what we're looking at, probably is a breath of fresh air, because some of the potential numbers are far more egregious than that. If we have that, it's going to be because of what we've done in the interim. So we can look at this and say, we have a negative 1%. Well, that's not all that bad. And then Heather might look at it and say, well, yeah, but because we spent $2 trillion. If we hadn't spent the $2 trillion, what would have been the contraction of GDP? 12%? 16%? I don't know. It would have been some very uncomfortable number. So when we look at these dollars that are going to be injected into the economy, and we know that when dollars come into the economy, those of us that have taken any macroeconomics courses, we know that those dollars are going to amp our spending through the Keynesian multiplier, or the marginal propensity to consume or spend. And it's going to amp this such that every dollar spent might actually be able to be spent again, again, and again until it's a very attractive economic benefit to us. And that would be very attractive. But I don't know exactly what those numbers are going to look, because some people are going to go out and take their $1,200 or their $2,400 and they're immediately going to spend it because they don't have enough income today. And some people are going to go spend it because they have maybe enough, but not enough for anything extra. And some people are going to spend part of it and save part of it. And some people are going to save all of it. And some people are going to use it to pay off debt. We don't have a nice aggregated marginal propensity to consume when we don't know what our unemployment numbers are going to be. So we're clearly into some guesswork here. So I think that all we can really say about parts of this is, will it have an effect? And the answer is absolutely. And you might say that that's tantamount to saying, will it be effective? And I would say, absolutely. I'm just not sure that it'll have the effects that you or I or decision makers in the halls of Congress expected it to have. We're not going to know that for some time. But we do know that bringing these dollars to households in months in which many of our households are feeling the pinch because at least one of the workers got laid off or their hours cut back, it's going to help, right? That and some unemployment may be enough to carry us through this deal. And maybe not. Maybe there will be another round of this. I'm hard put to believe there will be another round when the first round was $2 trillion. And that's not the extent of the monetary expansion. This is simply the fiscal policy expansion. We're not talking about the monetary policy expansion of the Federal Reserve's activity, and that was opened up and is expected to extend something to the nature of $4 trillion of increased money supply. So between the two, we may well inject $6 trillion into the economy. What's the potential problem in doing that?
I mean, that's a lot of, couldn't the value of the dollar just die?
Well, you're exactly right, Jason. That will devalue the dollar, or it runs that risk. We said this exact same thing in 2008 when we injected between the TARP rounds and the other stimulus programs that just came barely before that, and in the Federal Reserve's policy, we put about $2 to $3 trillion in that year. We're looking at about $6 trillion this year. 2 to 3 trillion, we expected to see some goodly amount of inflation or the devaluation of our dollar, right? Have we seen the inflation? Not really. Wages haven't gone up, not much. Price of bread, milk, haven't gone up much. Oh, sure, stock values did and then didn't. Real estate prices have. But we haven't seen what we would think of as domestic inflation, which is a little bit curious because in the past, anytime we'd expanded the monetary supply by so much, we saw an inflation effect or a devaluing of the dollar. Why have we not seen it this time? Any ideas?
Hey, Rick, I'm not going to interrupt, but I'm going to drop off. I appreciate the class. I appreciate putting this.
Thank you, Nate. You have a good night. So we didn't see that kind of inflation effect coming out of the financial crisis of 2008, but we didn't see it domestically. Doesn't mean we didn't see it. Think about this for a moment. Have we seen wage increases in China and in Malaysia? Sure we have. In fact, I think that Xi, I don't know if you have much contact with people in the Chinese market. I'm only assuming that you're from China given your name. Kang, I know you have some family in Vietnam. What's happened to wages in those polities?
The middle class has grown exponentially.
Yeah, in fact, they've more than doubled since the 2008 financial crisis. And commensurately, real estate has done the same thing. Other commodities and goods have done the same thing in those environments. So we haven't seen inflation here, but those countries have seen significant inflation, haven't they? Well, it's not that because of their own internal economic pressures. It's because of us using those countries as the workshop that from where we buy so many of our goods and services. So in Vietnam, we've seen wages rise, as King says, exponentially, because we've seen labor demand increase exponentially, because we have gone and had so many of our domestically consumed goods manufactured there. So we haven't seen the wage increase here. We haven't seen the inflation here, but it doesn't mean we haven't seen it. We just haven't seen it domestically. We are experiencing it internationally. And at some point, it would make sense that that might come home. So that's one of the effects. When we have such a high additional fiscal and monetary policy expansion, that weakening currency, even if it's weakening on a relative basis from other parts of the world, we call that a weaker dollar. Is that a good thing or a bad thing when the dollar gets weaker?
Bad.
Okay, so Heather, you're saying bad, and I think there's a lot of people that would agree with you, and many of them are very knowledgeable, and they are economic policymakers. Would anybody disagree?
Well, it just depends on how are we having too much surplus coming in? Are we exporting too much?
Yeah.
Those numbers.
So it depends, right, Scott? Now, what's the right answer? It depends. So from Heather's perspective, it might be a bad thing. If you are a domestic supplier of goods that you would like to sell in the foreign markets, it's a good thing, because when the dollar devalues, domestic goods become less expensive to those whose currency is stronger against our own. So it's less expensive for them. So our exports go up. So this is one of the reasons why so many very conservative economists don't mind having a weak dollar. You would think they would want a strong dollar, but many of them don't mind having a weak dollar because it motivates other countries to buy goods from our country because they became less expensive on a relative basis. And if we have a trade deficit that's as strong as ours is, maybe it would be good for us to have the dollar a little weaker so that we can improve that deficit, bring it back towards balance. If we had an out of control surplus, and that is possible, Germany has been running with an out of control surplus, then they want to weaken their currency so they can bring that closer to balance. So the 2008 stimulus programs, I think 2009 Recovery Act, were those simply bailouts, and did those simply cost the taxpayer money, as it looks like some of these items might?
So I thought of it.
Yeah, most people think of it that way, right? And the TARP, Targeted Asset Relief Program, $787 billion. So $800 billion, almost $1 trillion. It was money that was just bailed out banks and financial institutions and auto manufacturers, right? When we hear the word bailout, it connotes that this is money we sent out and we never get it back. Do any of you know, even in round terms, the economic benefit that we received from the bailouts? The last number I saw was we spent $787 billion in that Recovery Act, and we've gotten about $80 billion more than that back, because predominantly those were loans. And in fact, they were for the most part loans that had some realistic interest rates to them. Some of those loans never got paid back because those companies went out of business. Some of the loans got paid back, but they haven't paid back interest yet. Some got paid back principal and interest. And some of the monies were not given out as loans. Some of the monies went in to actually buy equity in companies. So at a point when we bailed out General Motors, the U.S. taxpayer became a 37% stakeholder in General Motors common stock. And after a period of years, when General Motors recovered, then the Treasury then sold that common stock in the open market, and it was nicely profitable. In fact, the entirety of that scenario has benefited the taxpayer by about $80 billion at this point. So the $787 that we spent, we've seen all of that back, and about $80 billion more. Well, in this bill, some of the money is going out there as grants for businesses. Some of the money is going out for loans for businesses. And some of the money is able to be spent to capitalize these businesses with equity acquisition. And so I don't know what it's going to look like because I don't know the counterfactual, right? I don't know what I don't know, but there's every reason to believe that not only will this have a significant economic effect to keep us from cataclysm that could possibly occur, but we have every reason to plausibly expect that those monies going to businesses in loans and equity will be able to come back to us as they survive and pay back. But there's a category of loan in here that we simply will not see back. That's the money that is being loaned to businesses to help them keep people employed. And those loans are forgiven if the company doesn't have layoffs. So here we've got VO Enterprises, and VO receives a $2 million loan from the federal government instead of laying off his 30 employees. And if VO is able to then evidence that he could have, would have, should have laid them off otherwise, but chose not to because he got this loan, then that loan will be forgiven. And that's showing up in this bill as grants. Well, that money is not going to get paid back. But think about the Keynesian multiplier again, and think about the fact that that money then was spent to give incomes to households that would have otherwise been laid off. So it doesn't take money out of our unemployment insurance resources. and it doesn't take money away from spending. And so that money has this repeated effect as it ripples through the economy, and it's altogether plausible that the tax receipts from some of that money could rival the actual amount of the grants themselves. It all depends on to what part of the economy and what tax rates those end up going to. So I think what I'm telling you here is what some of you have already felt. $2 trillion scares the living daylights out of me. $6 trillion about puts me into a coma, okay? And we're looking at, between the Federal Reserve activity and this fiscal policy, as much as $6 trillion of expansion. I think it tells us something of the enormity of the problem. And unlike many, I don't think we're going to see rampant or significant inflation immediately, but at some point we will have to pay that piper. And if we do, then we're paying back all this deficit spending with cheap dollars, right? So I'm not nearly as concerned about this as some. It will be effective. Whether or not it seems that way to you depends on what perspective you're coming from and your kind of job, your industry, your household needs, etc. Any question or comments in the middle of all that diatribe? I'm sorry I was rambling on there a bunch. Any comments?
So just out of curiosity, what resources are you looking at to gain knowledge on the overall return on that initial investment from 2008, 2009? If I search it, I can see the individual, well, the government earned X amount from Citi, X amount from AIG. Like, what site can I look at to give me a good?
That's a good question. Is this Tyler?
This is Ian.
Ian, thank you, Ian. I apologize. So
No
Ian, I don't recall off the top of my head. This was all very active when I was doing my doctoral work in economics at the University of Utah. And I recall seeing some of the white papers that came out of the Treasury and the Federal Reserve at the time. I might actually even have some of those. I'll see if I can find those, and if I can, I'll link them through WhatsApp for you guys. I apologize. I don't immediately recall, but I did see it. I am not the kind that will just spew as fact something that I heard at a water cooler. I'll only repeat to you guys that which I saw as credible primary research.
Certainly, I just asked the question solely because I think it would be a good read. So.
Oh yeah. Oh, absolutely. Absolutely, man. And please don't misunderstand my response. I wasn't defensive.
No.
It was a worthwhile question. It's the one you should always ask. Yeah, the biggest one in there was AIG, right?
Right.
That was a killer. I could look for a while like General Motors was going to be just a rat hole, and it ended up turning out very productive.
Yeah. So.
Anything else?
No, good thought. Thank you.
Okay. Well, guys, if you don't have any other questions or comments, I'll go ahead and sign out. It'll take me a while to get these posted online, and I hope you guys have a good night.
Thanks. Very, very much appreciated, Rick. Thanks.
You guys. Bye-bye.
Thanks. Bye.
Good night.
Good night.